All right, let's talk about something that gets every income investor's heart racing, and maybe a little nervous. We're looking at Dividend Growth Split Corp, ticker DGS, and it's throwing off a yield so high it just looks, well, it looks almost too good to be true. So, is this the golden ticket we've all been searching for, or is it a trap just waiting to be sprung? Let's dig in and find out.
I mean, seriously, just look at that number, 15.58%. In a world where you're happy to get 5%, this is just, it's completely off the charts. And it immediately makes you ask two very simple questions. One, how is that even possible? And two, the more important question, what's the catch?
And that is the billion-dollar question, isn't it? Today, we're going to dive into a deep dive analysis that did just that. It peeled back all the layers to figure out if this is a genuine under-the-radar opportunity or a classic textbook value trap. And trust me, by the end of this, we're going to have a very clear answer.
Okay, so before we can even begin to figure out if it's a trap, we first have to understand the machine itself. Because a split corp, you see, it's not a normal company. It's a very specific piece of financial engineering. So let's pop the hood and see how this thing is actually put together.
So the first clue is right there in the definition. This isn't a company that builds widgets or sells coffee. It's a structured investment vehicle. You can think of it like a special kind of basket that's built for one reason and one reason only, to take a bunch of solid dividend-paying stocks and use some financial wizardry to squeeze out an incredibly high yield.
So how does this wizardry actually work? Well, it's basically a four-step process. First, they take a bunch of investor money and just buy a portfolio of stocks. Simple enough. Second, they create something called preferred shares for one group of investors who just want a steady, fixed paycheck. But then, and here's the key, they issue capital shares. That's the DGS stock we're talking about. And those shares get all the leftovers, every single penny of extra dividend income and all the potential growth. And what this does is create leverage. It's like a giant magnifying glass. When the market's doing great, your returns get amplified. But, and this is a big but, when the market goes down, your losses get magnified just as much. It's a serious double-edged sword.
Okay, so now we get the basic mechanics. We know how it's built. Now for the fun part. Let's see what this deep dive analysis found when it put this whole structure under a microscope. This is where we really start to separate the sizzle from the steak.
This comparison right here tells you almost everything you need to know. On one hand, you've got a traditional company, a bank or a railroad. It produces a service, it has a competitive moat to protect it, and it generates its own cash. DBGS has none of that. It doesn't make anything, it just holds other stocks, it has zero competitive moat, it's completely reliant on the dividends from other companies, and its core feature isn't managing risk, it's amplifying it. They are fundamentally different beasts.
And as the analysis got deeper, some really big red flags started to pop up. There's no moat, which means anyone can copy this structure tomorrow. The balance sheet is described as structurally weak because that leverage we talked about, it's baked right in. The earnings are going to be all over the place because they depend entirely on the market. And maybe the scariest part for a value investor, at its current price, there's basically no margin of safety, no cushion if things go wrong. And this quote from the analysis it hits the nail on the head. That huge dividend yield isn't some secret sign of a bargain. It's the bait. It's designed to pull in investors who are only looking at the income, hoping they won't look too closely at the mountain of risk you have to take on to get it. In other words, it's a classic yield trap.
Okay, so the story seems pretty clear from a qualitative standpoint. But what about the hard data? This analysis actually puts scores on the risks and opportunities, so let's weigh the evidence and see what the numbers have to say.
And wow, the numbers do not pull any punches. The total risk score comes in at a 7.2 out of 10. That is firmly in the high risk zone. And it makes perfect sense when you look at the breakdown. A 9 out of 10 for earnings volatility, and 8 for business model risk. That is the direct result of that built-in leverage and total dependence on the whims of the market.
Now you'd think if you're taking on a 7.2 level of risk, the opportunity must be a 10 out of 10, right? Well, nope. The opportunity score is just 4.5, moderate. And look at that score for competitive advantage, a 2 out of 10. The picture here is crystal clear. You are being asked to take on a very high level of risk for what is, at best, a mediocre potential reward. That is just not a good trade-off.
The weighted SWOT analysis tells the exact same story. Sure, there are some strengths and opportunities, but look at how they get completely swamped by the weaknesses, which scored an 8. And especially the threats, scoring a massive 9 out of 10. When you add it all up, the scales tip heavily towards risk, not reward.
So, the risk is high. We've established that. But hey, every asset in the world has a price where it becomes a good buy. So, is there any price where DGS actually starts to make sense? Let's see what the numbers say about that. This chart lays it all out pretty clearly. The analyst's base case, their most probable estimate of what this thing is actually worth, is $6.50. The pessimistic bear case is a pretty scary $4.50. Now look where the price was trading, $7.80. It's way above the fair value estimate, and it's getting dangerously close to the pie-in-the-sky bull case scenario. That's not what you want to see.
Now, to get to a very specific buy price, the analysts set a clear and reasonable goal. They wanted to achieve an average annual return of 9% over a 16-year time horizon. So the question becomes, what price do you have to pay today to make that 9% return a realistic possibility?
And this table is fascinating. It shows us the answer. If you only wanted to hold for 10 years, you'd need to get in at $6.20 to hit that 9% target. But if you're in it for the long haul, for the full 16 years, you need an even bigger discount to account for all the things that could go wrong over that much time.
And that brings us to the single most important number in this entire analysis, $5.70. That's the price you would need to pay to have a reasonable shot at hitting that 9% annual return target over the long run. Now let's remember, where was the stock trading? $7.80. That is a massive, massive gap between the price you need and the price you have to pay.
So, we have looked at the structure, we've looked at the risks, we've looked at the valuation. It is time to put it all together and finally answer our original question. Is this 15% yield a golden opportunity, or is it a classic value trap?
And the analyst's verdict is pretty blunt. At its recent price, the answer is clear. Avoid. The risk you're taking on is just way too high for the price you're paying. The only way this investment starts to look interesting is if the market has a major panic and offers it up on a silver platter, a price much, much closer to that $5.70 target.
So let's lock in the key takeaways from all this. Number one, that giant 15.58% yield isn't a free lunch. It is the fee the market is paying you to take on an enormous amount of risk. Number two, the math shows the intrinsic value of this thing is somewhere between $6.20 and $7, well below the recent market price. Number three, remember that leverage. In a down market, it's going to crush your returns. And finally, number four, to make this work, you need a huge margin of safety. You've got to be buying below $5.70 to have a fighting chance at a decent return.
So the final verdict from this deep dive analysis is pretty clear. At its recent price, DGS is a yield trap. The risk just completely outweighs the reward. But that's just this one analysis. What do you think? Do you own this, or would you consider buying it if the price dropped? Let us know down in the comments. And while you're there, tell us what company or stock we should put under the microscope next. We read every single one of your suggestions.